hour, we are going to talk about iBuying because I think that you and I, Matt, have so many opinions on iBuying, and we're getting to the point where we're going to have Zillow and Redfin earnings soon. We've got uh, we've got OfferPad going public, and so there's just a lot happening right now. But the first thing I want to mention is that Case-Shiller numbers came out today. Did you see those?
I did not.
So numbers that Case-Shiller was up 14.6%, highest price in 30 years, 30 plus years, really. And the most interesting thing I keep finding about this is that Phoenix is the hottest market. And you think Phoenix is right now the actual hottest market because it's so warm there, but people keep moving.
Yeah, well, the warm places seem to be the hottest markets right now. Like Las Vegas is a particularly hot market as well. I actually heard a bigger statistic. I was reading on the National Association of Realtors website. The median sales price of existing homes is up 23.6% in May.
Mm-hmm.
That's pretty impressive and kind of makes me want to sell my house.
Yeah, this is, I think, one of the things that we're dealing with right now. And Jason Hall and I were talking about this last week. It's like, on the one hand, it's such good news for home buyers and not home buyers, home owners, because they have equity. But the affordability problem is just so massive that it's hard to cheer it on when you know it really prevents so many people from buying.
Yeah, no, and that's definitely true. We're starting to see inventories kind of tick back up to, I wouldn't say
Yeah.
normal levels, but the reason I was on
No.
the National Association of Realtors site was because I wanted to see kind of the pace of home sales. And in May, it was the highest it's been since the pandemic, which kind of indicates that inventories are coming back. It's not just crazy bidding wars that are getting the prices up. It's some inventory coming back onto the market.
Yeah, but it's 2.5 months. So, I mean, if a normal market is 6 months, and I feel like for a long time it was around 4 months, 4.5 months, which is tough but doable. But yeah, it's gone up a little bit, but 2.5 months is still very, very low.
Well, and on the affordability thing, it's kind of like a give and take when it comes to with mortgages as well. You mentioned, I want to say it was 13% or so that you just mentioned the home prices up year over year.
14.6 for
14
Case
points.
Shiller.
Okay. The difference in your mortgage payment with a 3% interest rate mortgage versus a 4% is about 12% difference in terms of cost savings. So even though home prices are a lot higher, the actual out-of-pocket monthly cost to a homeowner isn't that much more. It's the down payment thing that really affects the affordability issue, because 20% of 500,000 is a lot more than 20% of 400,000.
Exactly. And I think that's one of the reasons that we're also seeing all of these services pop up to allow you to be a cash buyer. But the thing with iBuyers right now is you would think that in a market like this, that maybe this would be a time that iBuyers wouldn't be buying as many homes with prices going up. And yet the weirdest thing is that kind of the opposite is happening. Redfin came out with a report, I think it was tail end of last week, that iBuyers are getting close to the pre-pandemic levels, and the numbers that Redfin has, I don't even think they included all of the iBuyers, because aside from the biggies, Redfin itself, Zillow, OfferPad, Open Door, there's also these other smaller ones that are kind of now coming forward with similar things. So I think it's even bigger than what Redfin reported, and it's really interesting to me that at this time when nobody can find a house, bidding wars are crazy, people are paying 100,000 over list price, iBuyers are still buying up homes. How is that even happening?
Well, iBuying does not have a giant market share nationwide yet. They're very
True.
concentrated in some of the biggest markets. You'll actually kick out of this. You know what Open Door's biggest market is right now? Phoenix,
Of course.
the hottest market in the
Didn't
country.
they start in Phoenix?
Yes, and they have about a 4% market share there. So Open Door is 4% of the market in Phoenix. There is some convenience when it comes to iBuying. You mentioned the affordability issue, and specifically, we just said down payments. It could be really hard to buy a home before you've sold your current home. I know I've had trouble doing that before. If I'm trying to sell a house, trying to buy a new house, you usually have to have some kind of contingency where you can't You can't close on the new one until you've sold your current home. So the iBuying thing takes the uncertainty out of that. It allows buyers to free up their equity right away. Because I'll tell you right now, with some of these bidding wars going on, if someone has a selling contingency in their offer, they're not going to get a house. So it can eliminate a selling contingency for people who have to move, which can give them a leg up. Because right now, it's not just the highest price that's getting the house. It's the most attractive offer, the quickest closes. I mean, I just bought a vacation home and we were in a bidding war against cash buyers, but we offered a quicker close. We offered to waive, we offered a shorter inspection period, a couple different things to sweeten the deal. So if you have to move, let's say someone has to move from South Carolina to Phoenix, using an iBuyer to sell your house quickly, a guaranteed sale, it's a cash offer, can make your offer on a new house a whole lot more attractive, which is one big value add these days in such a quick real estate market.
Well, I want to talk a little bit also about the moves of iBuyers, because that's part of the story too that we're tracking, is that it used to be like every time Open Door or one of the others they would go into one market at a time. They'd do a giant press release. It would be a whole to-do. They'd have a marketing campaign. Now I'm noticing 2, 3, 4 markets all at once. Open Door has 39 markets now. They just announced Reno, South Florida, Oklahoma City, Columbia, South Carolina, and Knoxville and Chattanooga. OfferPad just announced Columbus, Ohio, Kansas City, and St. Louis, and also Columbia, South Carolina. So apparently Columbia, South Carolina is getting ready for some iBuyers.
So maybe I might just see what they offer me for my house, because that's where I am.
I think you should.
I don't know why, because Columbia, South Carolina, I don't think is even in the top 100 cities by size in the country. I know we're a particularly hot real estate market right now, so that might have something to do with it. But no, their Open Door's goal is to be in 100 markets. They don't want to be nationwide. The economics just wouldn't make sense for them to be in some more rural areas of the Midwest, for example. The economics of iBuying just really wouldn't make sense. They just don't have the data to evaluate those markets as well. Because as we'll discuss, I'm sure, as we go on, profitability is very elusive in the iBuying business, to say the least.
It was very delicately put.
So the better data you have to be able to evaluate prices, the more efficient the business can theoretically become, which is why you see them concentrating on these bigger markets. It's not just for dominant market share. It's because those are the ones they have the most competency to evaluate. So they don't want to be in every market. They want to be in 100 markets. And they want a roughly 4% share of 100 markets. And that is pretty feasible when you look. Their original 6 markets, the first 6 markets they launched in, Open Door's been at this for 7 years. In their first 6 markets, they've already achieved a 4% market share. So it's definitely possible. This is and these aren't little markets. I mentioned Phoenix. This is places like Las Vegas, Atlanta. They have a roughly more than 4% share in those 2 markets, actually. So a big opportunity here. And if they do achieve a 4% share in the 100 markets they want to be in, that's $50 billion of annual revenue. This is not a small amount of money, and probably more. That was based on 2019 real estate figures. Now that, home prices are, twice what they were then, or 20-something% more than they were then, that's probably even more money. But I mean, the market strategy is interesting, and there's a lot of overlap. You mentioned 2 of them are launching in Columbia, South Carolina right now. That doesn't seem like a coincidence. That seems like a competitive strategy to kind of try to dominate certain markets and really go head to head and establish yourself as the presence in that market before your competitor can do it. Because I mean, if you look at the list of Open Doors and Zillow's markets, they're almost the same. Mm-hmm. And I mean, they're not the 25 biggest markets in the world or whatever, but there's so much overlap, and it's an interesting competitive strategy they use.
Well, I believe that part of the reason for that strategy is because of the housing stock in those markets, not as old and more homogenous. And one of the things that Mike Del Prete, who covers this space, wrote about recently on his website was what happens when these iBuyers they're now starting to move into Midwestern and Northeastern markets. So there you have so much older housing stock, and you also have housing stock that is just wildly different in terms of age, size, just all sorts of factors, and all of these iBuyers are trying to find that ideal algorithm, right? So that they can make these offers quickly and have them be, accurate and pencil out on the other side once they sell. I feel like this is going to be a huge challenge. I mean, it's really exciting to me because I feel like this is going to be the test. I thought that last year the pandemic was going to be the test, but that was a whole different kind of test.
Right. I mean, I think of iBuying the way I think of gas-powered cars 100 years ago. At the time, it was pretty obvious that that was the wave of the future. But 98% of the gas-powered car manufacturers ended up going bankrupt because it's really tough business to be profitable consistently. And like you said, that it's really about perfecting the algorithm and trying to find the competitive advantage over your peers. Because if you make terrible offers as an iBuyer, you'll go bankrupt in a month. It's such a high revenue business that if I mentioned Open Doors looking for $50 billion of revenue a year. If they do $50 billion worth of bad offers and are losing money on every house, that's a quick way to go out of business.
Yeah.
So, I mean, who do you think has the big advantages? Open Door is the biggest one. Let me give you just a couple of numbers. Of the three big ones that I know of, Open Door, Zillow, and Redfin. Open Door sold 2,500 homes in the last quarter. That's pretty good size number. Zillow was 1,422. Redfin was 171. So big gap between number two and number three. Do you think any of those have this are getting closer to kind of the secret sauce there yet?
I still, and I hate to say this, but I still feel like Zillow is going to be the closest, partly because of, the thing that real estate agents hate the most, the Zestimate. I mean, when you think about it, they've been spending years preparing for this. Not on purpose, I don't think, because the Zestimate came out so long ago, but they've had to figure this out for a long time ahead of everybody else.
Yeah, for a while, the Zestimate was pretty inaccurate.
Oh yeah,
and that's also putting it kindly. But if like, for example, my house's estimate varied by $50,000 in the course of 1 week at one point.
Oh my God!
So they just didn't. It was a newer technology.
Yeah.
But they have so much data that they're able to use to perfect this. Zillow has 225 million unique monthly visitors. Their site was visited 2.5 billion times. They have over 150 million homes in their database. That's a lot of pricing data that they're getting. So I think Zillow's kind of competitive advantage is that they're starting in certain markets to test using the Zestimate as their offer to really automate the process. Like you go to Zillow's site, look up the value of your home, boom, there's your Zestimate, there's your offer. That's what you can get all cash right now. That could put traditional home sales out of business if they perfect that. If it becomes that easy to sell your house, and because right now my Zestimate's pretty good. I mean, it's gone up about 25% in the past year. If I could sell my house for that with one click, if I wanted to sell my house, that's a pretty tempting offer. And people are going to Zillow's site anyway, which is where I see them really getting the competitive edge as they grow. No one goes to Open Door site unless they're looking to sell their house.
True.
So, I mean, no one goes to Redfin right now unless they're looking to sell their house or if they were referred by a Redfin agent. Zillow just has that traffic coming to its site anyway. And I could see that really help. I mean, there's room for more than one winner in the space. Let's be very clear on that. This is a huge market opportunity. But I could see Zillow kind of, running away from everybody else if they get it right.
Well, I think that that's definitely true. Is the traffic is just a huge advantage, but I do think that it's a little more I'm not quite sure it's going to be as simple as everybody turning to iBuyers. I mean, that's one of the things that I think you and I debate about is the future of brokerages. I think I'm a little more bullish on brokerages than you are. I think you're seeing the end of, not the end of real estate agents, but you're seeing them be phased out, I think a little faster than I am.
I think in 20 years, that's how iBuying is how we're going to buy and sell houses. Right now, the current pace of existing home sales in the U.S. is 5.8 million a year. That's about and based on the median existing sale price of $350,000, I never thought I'd see the day when the median existing home price was
Yeah.
350,000, not in a while anyway. But based on that, that means about $2 trillion of existing home sales volume. I think that will be mostly iBuying within 20 years. I think this is the future of the way we buy houses. I think they'll perfect their algorithms, like we just said. And if it's as simple as clicking on your Zestimate and getting a cash offer on your house, and then being able to go to Open Door and Redfin and OfferPad and et cetera, and getting competing offers and picking the best one, if it's really that easy to get a cash offer and control the closing time frame and free up your equity, I think that's absolutely how we're going to be buying and selling houses in 20 years. If people can figure out how to do it profitably. If they can't figure out how to do iBuying profitably, the industry is going to go away.
Well, that's what Rich Barton said in an earnings, I think it was Zillow's last earnings call, was that they weren't concerned about profitability at this point because they were more concerned about scale. So they weren't focused on the individual house. But I think that's, what you said is really interesting there, because there's an opportunity that I think some of the brokerages are starting to get into, which is that idea of aggregating the competitive offers. Because now, in the beginning you had one iBuyer, maybe two iBuyers in a market, but now you're having 2, 3, 4. So there is going to be at some point here the kayak of iBuyers or something like that, where you have the different offers all laid out for you.
Yeah, and I think that's really where you're going to see the turning point, is when in 100 of the biggest real estate markets in the country, you have 5 different offers on your house that are all cash iBuying offers that are fair market values, because the Zestimate's designed to be the fair market value of your house. It's not designed to be a bargain basement price.
Right.
The iBuyers make their money in other ways. I mean, Open Door charges a 7% fee. Zillow's average fee is 5%. Redfin charges 5 to 13% for an iBuying transaction. So they're making their money. That 5 to 7% even of a $350,000 average home it's not a small margin. If they could just make that their profit margin, if they can get it to that point, that'd be pretty impressive. But they really need to scale. Scale is important. Yes, these companies are trying to establish their dominance, which is where I think Rich Barton was going with that. Mm-hmm. They don't want to lose the race, in other words. But at some point, you're going to have to show a path to profitability, because no one's found it yet. Most of them are running something like a negative 7 to 10% profit margin on these. And that's a lot of money when you're talking about houses.
Yeah. Well, but the other place they're planning to make money, and everyone is trying to be the be-all, end-all platform. So a lot of them are looking at those ancillary things. They're looking at title. OfferPad just announced they're now licensed as a mortgage broker in a couple of places. Open Doors is in loans. Obviously, Zillow and Redfin also are expanding their mortgage and title. And Glenn Kelman of Redfin has absolutely said that in his opinion, they can't expand mortgage kind of fast enough. Like, they're trying to keep up with the demand and trying to open more offices as fast as they can.
Yeah, there's a lot of opportunities in the home selling process.
Right.
And a lot of what these iBuyers are trying to eliminate are these unforeseen costs of selling a house. You go to sell a house, the buyer inspects it, and then you got like a punch list of $5,000 worth of items they want fixed before they'll move on with the sale.
Yeah.
So they eliminate those, but there are a lot of other costs involved with selling a house. And a lot of people don't realize that, getting a mortgage has an origination fee, or the title insurance is part of the closing costs. That costs money. So if say Redfin or Zillow, which Zillow pretty much does offer everything right now, Open Door is getting there too. If they can control the entire transaction from buying the house to having the borrowers find a new house, because then you get a customer doing it on both sides, mm-hmm. to the mortgage process, the title process, the inspection process, having a Zillow home appraisals. I don't know if that exists yet, but it should.
It probably will.
It probably will at some point if it doesn't already. But there's a lot of little adjacent parts. The Zillow's version of U-Haul, where you can rent a moving truck from them. There's a lot of little ways, is my point. Yeah. That over time they could add these incremental revenue streams. So even if they could just break even on the house itself, but sell them a mortgage, sell them title insurance, sell them an appraisal, sell them an inspection, that's thousands of dollars per transaction right there.
Well, I think the other thing that I'm seeing that's interesting too, Redfin does this and Compass also does, which is the idea of the concierge program. So if you don't like the price that the iBuyer that just like, okay, we're going to buy it at this price, you can also opt for their concierge program where they, I believe in Redfin's case, they take like another percentage point of commission and they basically handle all of the improvements of the property. So you're sort of like, it's sort of like the iBuyer process, except that you actually have the potential to gain more of the money yourself directly if you go with the Redfin agent.
Yeah, that's really if you think that the offer they give you is not really market value,
Right.
which in today's market that probably happens pretty often. Um, I mean, in the hot markets, the Zestimate can't keep up with a lot of these markets. Open Doors algorithms can't really. I mean, if you're in a market where home prices are rising 3 or 4% every week, some of these iBuyers just aren't going to keep up with that. So if you say, no, this is a really hot market, my house is worth a lot more than it appraises for if I were to sell it on the open market, the concierge service definitely makes sense. And I think all of the iBuyers will have something like that eventually. They don't yet.
Yeah.
I know Redfin does. Zillow doesn't have a traditional
Yeah, but Redfin
brokerage
does because
business
it
right
started
now.
out as a brokerage. And
Right.
that's why
And
Compass has it, because it's a brokerage, so they get more, there's more value in shifting people over.
yeah, so I don't know if the bigger value is in Redfin now specifically right now, or it as a referral engine to their
Mhm.
brokerage business. And that would be an interesting point to see because Redfin has a pretty big share of a fragmented market. Their market share is well over 1% of the entire U.S. housing market right now. I'm curious to know how much of that comes from people who started at Redfin now trying to just get a quick offer and eventually just went the concierge route.
Well, and the other thing about Redfin that makes me optimistic about it too is that they're continuing to see their traffic grow. They cracked into the big three of top real estate search sites. They've upped their marketing in a lot of markets. They're spending a lot more money on advertising, and so I think they're in that kind of build awareness mode. Right now, it's interesting the ads from Zillow and the ads from Redfin are so similar. And they didn't used to be. So I'm finding that very interesting.
Well, Redfin, talking about things moving into Columbia, South Carolina, Redfin just came to Columbia about a year ago, I think, right shortly before the pandemic. Redfin now is not here, but the brokerage services.
Hmm.
And one of the really interesting things, traditional real estate agents hate Redfin.
Oh yeah.
They really do. Last time I gave kind of a pitch on Redfin about a year ago on when we first started full live, and the entire Q&A was filled with apparently we have a lot of realtors listening because the entire Q&A was full of people who Redfin's agents aren't as attentive. They don't add as much value. They don't know the local market as well. It's more of a technology play than the service you're getting. It's kind of it's an interesting war going on between Redfin and the traditional brokers. So, and they're taking share. I mean, they're a threat. They really are.
They're absolutely a threat. They've launched a luxury service. It's got slightly different branding. I've seen a couple of signs. But the interesting thing about Redfin that I noticed when I was working in real estate brokerages and working with like when we get a new agent and we're training them in it as an agent, those agents were so well prepared. Like an agent who'd spent like a year or two as a Redfin agent was sort of at the place of where a traditional agent would be in like 5 years because they had learned so much of the systems. They had to like transfer over their systems, and that was kind of hard for them a little bit mentally. But overall, they would crush it in sales because they were just so used to staying busy, and they would just kind of keep moving forward.
Yeah, I mean it's an efficiency play, right? I mean, Redfin's big value proposition is, yeah, we're going to charge you half the commission, but our agents can do double the amount of sales, so they're still going to make as much money. There's a few other, tech-focused real estate brokerages. EXPI,
Oh
EXP
yeah,
World Holdings
EXP.
is another
Yeah.
one. But it's a really interesting kind of dynamic there as how efficient they are. And I mean, the naysayers are probably right. They don't have quite as much personal assistance. They don't spend as much time with you, things like that. I know a lot of like showings can be done remotely with Redfin agents a lot of the time, for example.
Hmm.
But it's a more efficient business model, and I don't think people. I mean, there's always going to be a certain subset of the population that wants guidance and things like that. and really values the personal experience of a traditional realtor. But I gotta think that the iBuying process, once they've really like ironed out the kinks, will be very appealing to the majority of Americans.
Definitely. I want to bring up this comment from Max about, he says that Zillow by law could absolutely not do loans and appraisals because the law prohibits the lender from even knowing the appraiser, and you have to go through a third party, which leads to why the housing market is so fragmented. Good point to keep in mind.
That's true. Maybe a referral network for appraisers.
That's exactly where my brain went to. There's got to be some way for Zillow to
There's some way they can make money off the appraisal process.
Well, the appraisal process is the appraisal process and the inspection process, to me, are the areas that haven't quite been quote unquote disrupted yet. I mean, when you look at inspectors, especially inspectors, I mean, I don't know about you, but when you get an inspector, isn't it usually like a very small business?
Yeah, it's usually like one guy who runs this inspection service. He's a licensed inspector. Like I have my inspection guy.
Right.
So I'm a real estate investor. I use the same guy for every house just because he does a great job. And it's one person. He's got one guy in a pickup truck, and he's got his little logo on the side, but it's his business just by himself. Very fragmented business.
Yeah, I feel like that's one of those spots that is so ripe for someone to come along and systematize it to some extent. Because, I mean, if you've got an inspector, why do you have that inspector? Because that guy's good. But I would say the quality of inspector can differ very, very, very widely.
That's why when I found a good one, I stuck with him.
And people do, people share inspectors, and that's one of the things in real estate. Once you have a good one, everybody passes that person around, and you try to, you have to wait for that person sometimes because you just want the guy who actually, and it is usually a guy, but the person who goes into the attic, goes into the basement, really looks at all of the foundation. Just, you can tell the difference between someone who's kind of doing it right and someone who maybe you just don't trust.
I'll tell you a true story. When we had the inspection done on this house that I'm sitting in, it wasn't the same guy. It was, just some random home inspector we called because I didn't know this guy yet. He missed the fact that I had an entire wall that there is no power to. There are 4 outlets on one whole wall that the builder never ran power to. And now if I want power to there, I have to tear out 2 different walls. Oh. Because we discovered it about a year after the fact when the home was out of warranty. Because it's in my kid's playroom, so we didn't have anything plugged in there. We just had outlet caps on them. And completely missed that there was no power in the room. So it pays to have a good inspector.
Absolutely. I want to dive into some questions because we're getting a few here. Question from Celia. It seems like selling your home and moving to another is basically a wash where the premium you get for selling is canceled by the premium you have to pay to buy. And there's a lot of aggravation with bidding wars. Yeah, that is absolutely true in terms of what's happening right now. They call it they call it like housing gridlock or something like that. That's part of what's happening. That's part of why you're not seeing inventory tick up, because people are seeing those prices. If they could move, they would, because they can't afford to buy in somewhere else. You're seeing a little bit of that movement happen where people are, the impact of remote work, people leaving California to go to Idaho, for example, that's one that we're seeing. And in that case, yeah, your dollar goes farther, but even then, man, prices in like Boise, Idaho are, going way up. So that is a real concern in this market. And it's one of the reasons that it's so stuck. It seems to me in many ways to be one of the most stuck markets I've ever seen.
Well, I've seen statistics where about 25 to 30%, depending on who you ask, of people who wanted to sell their home over the past year delayed the sale due to the pandemic. So and historically, July and August are the 2 busiest months for homes coming on the market.
Yes.
So there's some reason to believe we might see an uptick in inventory, but at the same time, if you're just thinking about selling your home, you don't have to. My house has gone up, I want to say 30 to 40% since we bought it, depending on which estimate you're looking at. I'd still have to buy another inflated house if I sold it. And like Celia said, deal with bidding wars and all the aggravation. So why would right now it's a paper gain. Where you're going to see this come into play is the refinancing market. We saw one giant wave of refinancing last year because interest rates were like almost nothing. They were pretty much giving mortgages away. I know I refinanced. I know our colleague Anand Chakavalu refinanced twice last year because rates dropped and then they dropped again. Pretty much everyone I've talked to refinanced last year. That was before home prices rose by another 15%. Now everyone has 15% more equity in their home. So you're going to see another wave of refinances where people take some of that equity out because borrowing against the value of your house is probably the cheapest way to borrow money. If you could borrow money at like 3% compared to a credit card at 18% or a personal loan at 7 or 8%, even it's a no-brainer. If you want to do some home repairs, the guy who put in my pool said he's backed up by a year and a half now, and the specific reason he gave is that people have a lot more money to borrow from their homes to do projects with. So if people wanted a $50,000 pool a year ago, they might not have been able to afford it. Now they could take that $50,000 out of their house and get on the waiting list. So they're doing that. And so where you're really going to see the home values come into play is the refinancing market. Mortgage volumes are going to remain elevated for some time. If home prices rise another 20% over the next year, it'll happen all over again. But don't make the mistake to think that refinancing boom is dead just yet.
That is a really interesting point. And you brought up something else that I think is interesting there, which is that home improvement market just keeps booming, partly because everybody can get money, and also everybody believes that every improvement they make is going to make them money, which isn't really the case, especially with a pool.
Yeah,
but,
no, I'm under no delusions my pool's going to make me money.
No, but people do think that it almost doesn't matter what they do to their house because they believe the prices are going to keep going up. And I understand that because we've been in, and it's, what are we at, 111 months in a row of price gains. And so that sort of stretches the bounds of sort of memory from a like psychological standpoint, is that a lot of people who own a house now don't remember a time when their house was worth less because they didn't own a house at that point. And that feels risky to me.
It is. And I mean, historically, home values don't decline as much as the stock market does. It's not like, the ups and downs, but it does happen. Your home is not always going to go up. Most home improvements, by most, I mean like 95% of them, do not pay for themselves in terms of added equity.
Right.
Remodeling.com puts out a great list every year about this. And there's like
their cost versus value report. I love that report.
Yeah, the cost versus value report. And there are only like 2 or 3 on there that I've ever seen over 100% return on equity or return on investment. And they're always kind of small things, like an upgraded garage door is one.
Yes, that one always mystifies me. The garage door is apparently a good investment.
I could see that if your original garage door was terrible, like if it had like a baseball holes in it or something like that. A stone veneer on the house is another one that often makes the and a new deck, if your house doesn't have one, is a good way to return value. But most improvements, including things like kitchen renovations, bathroom renovations, I mean, pools, forget it. I'd be lucky to get half the money I put in the pool. I wouldn't have put a pool in if we weren't planning on staying this house for 20 years.
Right.
But most improvements they add to your equity, but not as much as you're putting in. So if you borrow $50,000 against your house to do a home improvement project, you're not going to get $50,000 of value out of it. Borrow it, do that because it's something you want to do, and not because you're going to get use and enjoyment out of it, not because you think it's going to make you money.
Absolutely. Let's dive into some questions.
Sure.
Sanjay asks, I'm curious why Redfin's stock price isn't through the roof in this environment. What type of real estate market is ideal for Redfin? Redfin's stock price was through the roof last year. I think that, that certainly Redfin had a huge year last year, capitalizing on the housing boom. So I feel like I believe there will be another boom for Redfin stock. So I don't believe there's been a lot of talk, certainly last year, less so this year, about it being overvalued. And I think that's why we saw it tick down a little bit this year.
I mean, the ideal market for Redfin is a lot of inventory because they're a brokerage at heart.
Yes.
Right now, inventory is very, very low. Prices are up, but that doesn't make up for the fact that like inventory is like, half the normal level. The high prices and high inventory, and kind of, I would say almost too much inventory would be ideal for Redfin and Zillow and Opendoor, because it adds to the value of the iBuying business. If you can't sell your home quickly, it gives you a lot more of a reason to use an iBuyer. Right now, if I put my house on the market today, it would be sold by tomorrow.
Yeah.
One of the big value adds, I mean, we mentioned controlling costs earlier, but one of the other big value adds of iBuying is you can control the timeline. If I want to just accept a cash offer today and close in 10 days, I could do that with an iBuyer. I could do that right now with any real estate agent I find. The market's that hot right now. So if homes are sitting on the market for 3 and 6 months because of an oversupply issue, that's when the iBuying process really has value. Because if I can accept an offer tomorrow and close in 2 weeks if I want to, and my neighbor's house is sitting on the market for 6 months, that's a big reason to use an iBuyer like Redfin now, or Zillow Offers, or Opendoor. So I think that from both sides of Redfin's business, a slight, not a terrible oversupply. You don't want like a flood on the market, but a slight imbalance in the supply to the other direction would be an ideal market for Redfin's business.
Well, and I think the other thing too is that, and I've talked about this before, is with the iBuyers now, a lot of the homes that they buy and fix are being sold to Invitation Homes, other single family rental portfolios. We've talked before about the amount of money going to single family rentals right now, and these portfolios is mind boggling. I feel like it's like every other day I hear about some $1 billion fund to acquire a whole bunch of single family rentals. So that is interesting to me as a long-term trend, because you're sort of watching some of these houses kind of be recycled into rentals and if there is a flood on the market, it won't be like what happened in the great financial crisis, because that flood will, as it stands now, would almost immediately be snapped up.
I'm glad you brought that up. I could see these single family real estate investment trust REITs getting a lot bigger because of this trend.
Mm-hmm.
Right now, I mean, if you look at most commercial property types, hotels, apartment buildings, malls, they're about 40 to 50% owned by REITs. The penetration rate for single family homes is less than 1%.
Yeah.
For REITs. I don't have the actual statistic in front of me, the percent of single family homes that are rentals, but it's in like the 20 to 30% range. Mm-hmm. in most markets. There's a lot of room for REIT consolidation in the space. I could see new REITs popping up to kind of create single family portfolios, especially what's to stop Zillow or Opendoor from creating its own REIT and spinning it off or something like that? Kind of a natural source of buyers for the properties they acquire. I could see one of them doing that.
Well,
I just patent that idea. I just kind of came up with that.
Right. I just wrote a story about it's a startup called Arrived Homes that I've been following for a while. One of the thing that they're doing that I think is really interesting is, and I'm not sure it's going to work, is they're turning every single family into a private REIT. So you have a single family home, maybe it's worth, they started in like Arkansas, Charleston, South Carolina, a couple other places. There's like 100 investors on a $200,000 or $300,000 house that has a renter in it. Each one as an individual REIT. It's an interesting concept to me. I'm still not sold on it, but that's sort of like a variant of that idea.
Yeah, I like that idea. I think there's a whole lot of different directions they could take this thing. Let me see. Celia had another good question that I wanted to hit while it's still on when I'm thinking about it. Do you think iBuying will ever come to communities that have older housing stock? I like that because you mentioned specifically where the real estate's kind of like monotonous in a certain area. Mm-hmm. For example, to the Northeast Railroad suburbs of the turn of the 19th to 20th centuries. I think iBuyers are generally going to stick with those top 100 markets for the most part. I could see them kind of doing a hybrid model when it comes to the older neighborhoods and kind of more rural areas, where you request an offer from like an Opendoor and they order an appraisal and then they make you an offer, or something to that effect, where they don't have great data and where every house is really, really different. Because if I look at, I mean, there's the downtown Columbia area, most of the houses were built in the 1930s. If I look at 5 of those houses, I'm going to find 5 houses in very different condition.
Oh yeah.
All the rental properties I've bought in downtown Columbia were built in the 30s. And I could tell you that inspections, you will be surprised to one direction or the other. You'll be either really disappointed at how it turns out or really surprised that a house that old is still in good shape. A lot of variability when it gets to the older houses. So I could see them developing some sort of hybrid iBuying model for the rural and older markets. But I think for the most part, they would concentrate in the bigger areas. I read in Open Door, the 100 markets that they mentioned they want to be in is over 80% of the addressable homes they could buy. So there's not that much of a reason for them to invest in the 20% or less of markets where they don't really have a core competency in. It's kind of my take on that.
Well, and the other thing too is what we just talked about is they aren't going to work in markets where I think to some extent where they don't have that single family rental demand as a sort of, as a secondary option if they can't sell it to a traditional home buyer. So I think that might be part of it too.
Fee Father has a really good question on iBuying. As someone looking to sell their house soon, the advantage I see of using an agent in this market is their ability to manage a bidding war. In your opinions, how cool does the market need to be for iBuying to overcome this advantage? That's a very, very good point. If you sell to an iBuyer, especially in this market, you're not going to get what you would on the open market generally.
Right.
They will make you a pretty modest offer, a fair but modest offer. It will not be what you're going to get, especially if your market is full of bidding wars. So that's definitely one thing to consider. That's not the value that iBuying really brings to the table. I mean, right now you can have your house 0 days on the market, which is one of the things Open Door kind of brags about, which isn't really an advantage right now. Predictability of costs is one. Not only are you going to pay your realtor, but then there's going to be a bunch of unforeseen transaction fees and repairs and whatnot. You get an all cash offer, which you might not even in a bidding war. Most buyers today still use mortgages, the vast majority, especially if you're not in an area. If you're in an area where there's a lot of investors, you might get some cash offers. But if you're in an area where families just want to buy a house, they're probably going to be using mortgages. So you get an all cash offer, a very certain time frame, and you can control the closing timeline. Open Door lets people close in as little as 3 days. That's a very, very, very quick close. So if you need to sell your house quickly and want the money in hand quickly, let's say you found the perfect house to buy and want to free up that capital in 3 days, so you could put an escrow deposit in. That's an option with an iBuyer. So there's a lot of value they bring to the table. But if your objective is to maximize the amount of money you get in the sale, iBuying at this stage of the game is probably not the way to go.
Well, and the other thing that the iBuyers do, which we haven't really talked about yet, is they also work with the home builders. So in some cases, you want to sell your house, but you maybe can't move into it right away because you've got your new house hasn't been built yet. So Open Door and others work on the other end too, that if you have to stay in your house for 90 days, you can do that as well. And that is the other factor here too, is home building. A lot of the iBuyers are working with home builders directly to kind of make that transition seamless. And so that's something else that is part of this equation as well.
Yeah, there's a lot of value. I think it's actually up to like 180 days with some of them.
Yeah.
Where you could, okay, we'll buy your house in 6 months. That's not what you can get in the open market. If someone's in a bidding war for your house, you could bet they want to close in a month or maybe 2 at the most. So they want that house. So there's other value, but like I said, to maximize your profit potential, you're better off listing it at this stage. And when like Deidre said, when there's the kayak of iBuyers. That might not be the case. You could probably maximize your value by getting 5 competing offers. But we're not there yet.
No, but that is what's going to be interesting when you've got 3 or 4 of them in the same market and they're competing for the same house. That's when it's going to get really fun.
Yep. All right. So
I wanted to grab this question on thoughts on Compass, because Compass IPO'd, recently, start of April at $20 a share. It's now sitting at $13.5 a share. You know, the brokerage I used to work at got bought by another company and then got bought by Compass. So I have some opinions on Compass, because I know a lot of agents that work for Compass. Robert Refkin, the CEO's original goal was to have a 20% market share in 20 markets by 2020. That didn't happen. They are getting a larger share of the luxury market, but they are really a company that has grown almost exclusively by acquisition. And that's the thing that makes me a little bit nervous about Compass long term, is that they just bought just a ton of independent brokerages in top tier markets, like Los Angeles, New York, Boston, et cetera. And they also bought a lot of technology. They bought a lot of smaller startups that deal with real estate CRMs and things like that. And they're investing a lot in engineering talent, but they really have to stitch together a whole bunch of companies in order to make Compass really stay there for the long term. And the other thing is, with Compass, it's just a real estate brokerage. And I say that as someone who invests in Realogy, Remax, and some of the others, but it is at its core not a disruptor, in my opinion. It's just a more efficient real estate brokerage.
So you just gave your thoughts on Compass. I will grab another any thoughts question. Hi, any thoughts on Fundrise? Yeah, I'm not a big fan, and I'll tell you why. I'm definitely a REIT fan. Fundrise, if you're not familiar, they're the e-REIT company. They offer private REITs it works similar to a mutual fund. You put money into a pool, you have to redeem your shares directly with the company when you want to get out, things like that. I like REITs. I invest in REITs and rental properties. And the biggest benefit to REITs over rental properties is that they're liquid. I can click the buy button and sell them whenever I want to. That's not the case with e-REITs. Fundrise actually suspended redemptions in April, May, June of last year. You couldn't redeem your shares. If you needed your cash, you were stuck, which during an economic crisis isn't really what you want to have happen with your investments. If I needed to sell my, say, Realty Income shares last year, I wouldn't want to sell them at a depressed valuation, but I could have very easily. Things like that really turn me off about the e-REIT model that they have, because to redeem those, if I sell my Realty Income shares, someone else on the other side buys it. If I redeem my e-REIT shares, Fundrise has to buy them, which is why they suspended, because they didn't want to, kind of have a run on their cash reserves. But I like the publicly traded REIT model the best of any kind. There are private REITs, there are public but non-listed REITs, which I guess is kind of what Fundrise would be classified as. And then there are public listed REITs, which are pretty much what we talk about. I am a big fan of the latter, and I really don't see any benefit to going the other way with them. That's kind of my opinion on Fundrise. Great reputable company. I don't know if Deidre has any thoughts.
I do. I like Fundrise. Yeah, the fees are a little high, but overall, I feel like Fundrise is, when it comes to Regulation A, they are the biggies in this space. They just announced a $300 million credit facility, because they're going all in with Goldman Sachs, because they're doing massive amounts of single family build to rent they bought a community from D.R. Horton tail end of last year. They're working with a whole bunch of home builders. Their strategy overall, is Sunbelt, single family, and also multifamily. I've been a Fundrise investor for a couple of years. I also invest in REITs, of course. Is Fundrise crushing the REITs? No. And because Fundrise is sort of really all in on multifamily right now, it's a little bit more of it's a little less diversified, I think, than it used to be. But I still like Fundrise. I also own some. I participate in Realty Moguls, one of their REITs as well, one of their private REITs.
Yeah, and that's fair to say. They're a good play on the multifamily space right now, but so are a lot of the publicly traded REITs I follow.
Yeah, it's
and
true.
I can't make the case for owning both. is kind of where I'm at with it. I don't dislike the company. I mean, it's a good product. Their fees are a little on the higher end, but they're reasonable.
True.
So I mean, I wouldn't say they're, there are companies with higher and more outrageous fees than Fundrise. I'll tell you that much. So let's see. How about JP says, how about solar on the roof from return on improvement cost perspective? Depends where you are, is the short answer. You're not going to get 100%. You're just not.
Also depends on how you finance it and what you do. Solar loans can be really complicated when you want to try and sell your house. So if you have to finance it, I think be really careful with that, because I've seen some deals get just messed up because of solar loans.
Yeah, or the solar leasing. That's even worse.
Yes, that is absolutely even worse.
Usually, the guys that pull you aside at Home Depot and try to offer you solar panels, usually they're solar leasing models. I'm not a fan of solar leasing. That's as your certified financial planner here, not just your real estate guy.
Yes.
Solar leasing.
Listen to this, man. You're
solar leasing
right.
is generally not the way to go. I would say if you're going to buy solar panels, either pay for them in cash or finance them through some way that's not like a solar loan.
Yes.
If you could finance them through a home equity loan, you're going to use them for a few years to, essentially eliminate your electric bill, and then you want to sell them as part of your house. That could be a smart economic decision, because they do add value to your house. It depends. A lot of home improvements, on that note, it's really interesting to mention, vary from geographic location. Take the pool, for example.
Mm-hmm.
In most parts of the country, a pool will not add a ton of value to your house, but it adds more value to my house in South Carolina, where it's 105 degrees during the summer, than it would to a house in New Jersey. The only market that I've heard of where it adds more than 100% of its cost is the Florida Keys, where I used to live. Because buyers expect it. You could swim all year round, and there's so few houses there, the buyers just want a pool. And the only pools you could put in are like literally the size of this room that I'm in, because everything's so small down there. So it doesn't cost you a ton to put in, and you'll get your money back for it. But there are very few markets where a pool makes sense. The same can be said for a lot of other modifications that you can make to your house too. Like a deck is more beneficial in a place where it's comfortable outdoors more of the year, than somewhere where it's hot year round. Ask your realtor. Ask a experienced realtor is kind of the best way to go.
Yeah.
Let's see. Any questions you see? I see a few.
Oh, I like this one for you. Jenny asked, what do you think of the Simon Property Group SPAC?
I always get the SPAC questions.
I know.
I don't own it just because I kind of pared down the number of SPACs that I have. So it's sponsored by Simon Property Group. I love the ability they've shown to allocate capital in a responsible way. They've done a great job of buying up retailers that were distressed. The Aeropostale acquisition a few years ago is already profitable. The Forever 21 acquisition that they made last year is already returning something like 50% of their original cost annually. Like, that's a great return on investment. So I'm optimistic. I think the SPAC space in general is very crowded right now. There are about 400 different ones looking for deals. So they have a lot of competition. They bring a lot of value to the table with their connections. The connection with Simon Property Group adds a ton of value for a struggling retailer that might want to go public through their SPAC. I think they're going to find a target that's worthwhile.
But do you think it's absolutely going to be a retailer?
I think it's going to be some type of business they could incorporate into their mall. That doesn't necessarily mean a retailer. I think it could be, a hotel operator. It could be a co-working business. It could be an entertainment operator. It could be a restaurant chain. I would not be surprised to see them take a privately held restaurant chain public through their SPAC at all, because that's a big component to Simon's property. Or a big selling point is you can eat at nice restaurants here that you normally wouldn't see at malls. So, a lot of mall operators are trying to think outside the box, and them having a real association and investment in a non-retail company could be a good way to use that. I think that, don't quote me on this, I think they raised about $300 million in their IPO. So they have a good war chest to go shopping with. But as far as the SPAC market goes, I have cut myself off. I'm a SPAC addict, so I cut myself off from buying any more pre-deal SPACs. I own Chamath's 2, IPOD, and IPOF. Those are the only two, and Yellowstone Acquisition, Boston Omaha SPAC. But I prefer to invest in Boston Omaha directly. It's Boston Omaha and Simon are the only two publicly traded SPAC sponsors that I know of, where you can invest in the SPAC from the sponsor side of the equation, because the economics really favor the sponsor. Simon is too big for it to really be a needle mover. If Simon like finds the next DraftKings, which was probably the most successful SPAC deal of all time, if they find something like that, it could be a needle mover. But Boston Omaha is small enough that their SPAC could really be a needle mover because the economics really favor the sponsor, which is why SPACs are very controversial. That's the main reason. But I'm very curious to see what they buy. Depending on what the target is, I might buy shares. I'm allowed to buy shares of SPACs that have declared their target, but not pre-deal.
Makes sense. Got a question from Lo on Tesla's solar panels. Tesla's solar panels, so freaking disappointing to me, because I really thought when they were first debuted and they were showing all those renderings, I thought they were great. I thought the idea was great. The execution has been dreadful, I guess is the best way to put it. It has not worked out. So
yeah, I don't comment much on Tesla because I get threats on Reddit when I do. I was a Solar City investor before they merged. I was an early Tesla investor and got out too early, which is maybe why I'm bitter about the company. But I was a Solar City investor, and that's kind of where their solar operation came from.
Right.
Everyone always thinks of Elon Musk as SpaceX and Tesla, but Solar City was one of his too. So I don't know. I like you said, not the best execution in the world. We'll leave it at that. But there's
beautiful
potential
design,
there.
though. Beautiful design, but yeah.
Yeah. I mean, I don't know. Are you a Tesla investor?
No.
Okay. We're still friends then.
I've got a couple of questions on BlackRock buying home partners.
I am actually, I shouldn't say, but I am not too familiar with that deal. I don't know. Have you dug into that one at all? I don't want to comment on a deal that I'm not that familiar with.
Yeah.
I see the questions. I will definitely dig into that, and we will get back to you. You could probably use that to get Deidre to convince me to come back next week or the next after that.
Question from Miss Melanie. In the RTP area, in the under 350,000 price range, there's absolutely a bidding war. Dozens of $30,000 over asking prices. All cash offers win. Younger buyers who don't have access to that kind of cash will have to use a service like Ribbon to become cash buyers and then get a mortgage. Really good point there about Ribbon, and there's other services like that. There's been a startup boom there. Lots of venture capital kind of going to that. Which is always the fascinating thing about real estate venture capital in general, is that it'll kind of go to stitch together those pieces of the market where there's a need, and that's definitely been one in the past couple of years.
Yeah, and I mean, there are ways to sweeten the deal. You can remove some contingencies if you're comfortable doing that. A lot of people have success with like adding a personal note saying, I'm not an investor, this is a house for me and my family, and we're going to make memories there and things like that.
Oh, the NAR hates that.
That might sound silly, but people do that and it's successful.
Yeah, but it's got all sorts of fair housing issues. The National Association of Realtors has they are very anti that.
Okay, well, don't take my advice on that.
No, it does work though. That's the thing. It's been a problem for real estate agents to sort of figure out whether they should do that
it levels the playing field. I'm in favor of it. I mean, I'm not saying go ahead and do it, but if I were making the rules, I would tell people to do it. But no, like with mine, we reduced the inspection period a little bit. The services like Ribbon are definitely filling that void. They're not free.
No.
But they're definitely filling that void. But there are ways to effectively compete against cash buyers. I mean, get a full pre-approval before you submit your offer, for example.
Use an escalation clause.
Yeah, use an escalation. That's the next thing. Use an escalation clause to, outbid any cash offer by a little bit, which is one of the ways we got our vacation property.
Oh, smart.
we offered, I think, 1,000 over whatever the next confirmed offer was. So we ended up getting it that way. There are ways to compete against cash buyers without having to go through the services. But I mean, as far as bidding wars, that's just how the market is right now in certain places. There's really no advice I can give you to avoid bidding wars.